A great way for energy companies to benefit from pipeline delays is by already having a pipeline. While the Trans Mountain Expansion Pipeline faces potential delays from permitting to most recently construction challenges, Enbridge's main line looks pretty full and the company's been locking in volumes. A rising tide of oil supply is great news for Enbridge, while it still controls around 70% of Canada's takeaway capacity. Sector strategist Stephen Ellis thinks Enbridge is increasingly in the driver's seat ahead of the competing Trans Mountain Expansion entering service early this year. When that pipeline opens, it will have to begin covering the $30 billion in costs it took to get there, which Ellis says puts the idea of a cheaper and more efficient pathway under siege. And Enbridge is pressing its advantage. Last year's tolling agreement lowered mainline tariffs and extended contract terms to the end of 2028. The company is also investing in projects like the Houston Oil Terminal, providing more options and capacity for shippers to move barrels down the Gulf Coast along the full pathway of the mainline. Like the contracts, however, the good times can still come to an end. We're far more uncertain about the long-term demand for oil given the emissions intensity, especially with the oil sands. Enbridge isn't sitting still on the threat, however, having recently entered a $1 billion sustainability-linked credit facility and a $1 billion bond which links its ESG performance to borrowing costs. And it may be necessary, as with new pipeline projects the size of Line 3 unlikely for years, Enbridge's 5% growth profile and great dividends will need to come from other businesses like gas distribution and perhaps eventually renewables. For Morningstar, I'm Andrew Willis.